7 diversification strategies for your investment portfolio. Diversification is a key part of risk management with the goal to enhance and preserve your portfolio's value. For investors, one of the most important considerations is how to manage portfolio risk. Diversification is the practice of building a portfolio with a variety of investments that have different expected returns and risks. Expected risks and returns. The benefit of diversification in your investment portfolio. Diversification can protect you against events that would affect specific investments. As an example, let's look at industry-specific risk found in energy stocks. If the price of oil falls, it's possible that multiple corporations that work in gas and oil may see their share prices fall. If you've invested in industries aside from energy, that decline in value would likely have less of an impact on your portfolio. Diversification does not guarantee returns or protect against losses and can help mitigate some, but not all, risk. For example, systematic risks, which include inflation, interest rates, or geopolitical events, can cause instability in markets and affect the broader economy and overall market. Overall. Here are 7 strategies you can use to diversify your portfolio. Number 1, determine correlation. It's important to consider the correlation between the investments in your portfolio. Even if you own many different investments, if they all trend up or down together, your portfolio isn't appropriately diversified. For instance, high yield bonds often have a positive correlation with stocks. Therefore, a portfolio made up entirely of high yield bonds and stocks is not well diversified. Number 2, diversify across asset classes. Investing offers several asset classes to choose from, including equities, stocks, fixed income investments, bonds, cash and cash equivalents, real assets, including property and commodities. These asset classes have varying levels of risk and returns, so including investments across asset classes will help you create a diversified portfolio. Diversification. Diversified investment portfolios generally contain at least 2 asset classes. Number 3, diversify within asset classes. Following are a few ways to diversify within an asset class. Industry. If you invest in energy stocks, for instance, consider adding tech, biotech, utility, retail, and other sectors to your portfolio. Fixed income investments, bonds. Look for bonds with different maturities and from different issuers, including the U.S. government and corporations. Funds. While some funds track the overall stock market, known as index funds, other funds focus on specific segments of the stock market. If your goal is diversification, check what stocks your funds invest in to make sure you're not overly exposed to one area or another. Number 4, diversify by location. Asset classes aren't the only way to diversify. It's a good idea to consider location and global exposure. For example, if you only own U.S. securities, your entire portfolio is subject to U.S. specific risk. Foreign stocks and bonds can increase a portfolio's diversification, but are subject to country-specific risks, such as foreign taxation, currency risks, and risks associated with political and economic development. Number 5, explore alternative investments. If you're seeking additional diversification, asset classes such as real estate investment trusts and commodities are potential options. Real estate investment trusts owns and operates properties such as office buildings, shopping centers, or apartment buildings. Owning shares in a real estate investment trust gives you the chance to receive a portion of the earnings of those businesses in dividends. Additionally, real estate investment trusts are not strongly correlated with stocks or bonds. Commodity investments are investments in physical goods, from gold to natural gas to wheat and even cattle. You can buy commodities directly or through a commodity fund. Number 6, rebalance your portfolio regularly. Even the most diversified portfolio needs to be rebalanced. Over time, certain investments will gain value while others lose it. Rebalancing is a negotiation between risk and reward that can help your portfolio stay on track amidst the market highs and lows. There are certain situations that might trigger rebalancing, including market volatility and major life events. Read more about when to rebalance your portfolio. Number 7, consider your risk tolerance. Your tolerance for risk can impact your approach to diversification. Generally, the longer your time frame, the more you can weather short-term losses for the potential to capture long-term gains. Aggressive investors generally have time horizons of 30 or more years. With this flexibility, they have a higher risk tolerance and can allocate 90% of their money to stocks and just 10% to bonds. Moderate investors, who have approximately 20 years before they need their money, generally allocate a lower percentage to stocks than an aggressive investor. For example, they may have 70% of their funds in stocks and 30% in bonds. Conservative investors, those who have little risk tolerance or will need their money in 10 or fewer years, may do a 50-50 balance between stocks and bonds. U.S. Wealth Management, U.S. Bank, U.S. Bancorp Investments. 7 diversification strategies for your investment portfolio.